This is what investing $30 every single day gets you in the stock market. So for reference, this is my entire portfolio, but in today's video, I won't be covering so much about my portfolio. I'll be actually covering this mini side project that I've been building over the past 8 months or so, and this portfolio actually belongs to my brother. So my brother is currently in the army. He is currently around 19 years of age, and in Singapore, you are mandated to serve a 2-year military service as soon as you turn 18 years of age. So I'm getting him to put in around $800 every single month, and I'll only add to positions that are relatively safe when the downside is minimized. So he has plenty of time on his side to allow the compounding to take place, and that's why I'm getting him to invest his money early so that the compounding comes into effect as soon as he gets started. As for the portfolio strategy here, I'm leaning more towards your ETFs as well as extreme high conviction setups to minimize the downside risk. So I only pick individual stocks that provide asymmetrical upside, and here are the 2 holdings in its entire portfolio that's achieved decent returns over time. So the first position is SCHG. SCHG is currently a position that is up around 28%. So I added this ETF over here during the April dip when the markets actually fell around 20% and your QQQ fell around 25%. So for SCHG, it is actually more diversified as compared to your QQQ. It is similar to your QQQ, but for QQQ, it can only incorporate stocks in your Nasdaq. So there's only around 100 stocks in your QQQ, whereas for SCHG, it holds around 245 different stocks. So SCHG is not only more diversified, it also filters your stocks out quarterly based on different metrics, based on different objective metrics. And besides that, the expense ratio for your SCHG is actually lower as compared to your QQQ. So while the difference in your expense ratio doesn't look massive here, if we were to allow our portfolio to compound over the next 10, 20 years, all these small little things will add up and compound and snowball. So take note of the difference in the expense ratio here. As for growth ETF, I think SCHG is probably the best one out there. And so for growth ETF, I think SCHG is probably the best one out there. The second position that I added heavily into as well for him is actually Google. So I've trimmed some of his Google position because it was getting a bit too large relative to his entire portfolio. His current net worth is around $20,000 and around $17,000 is actually in this portfolio. So Google was getting a bit too big relative to his entire portfolio size, and that's why I decided to trim the position for him just a few weeks ago. And for Google, I actually added this position for him all the way down. So I started adding to Google at around $185 a share, and I added all the way down till the April low. For Google, I viewed it as a stock that provided asymmetrical upside. That's why I continually added down for him all the way until $148 a share. The stock now is around fairly priced, I would say. The stock now is currently fairly priced to slightly overvalued. And so for Google, I won't be adding to this position. I will probably be trimming it down for him if it gets a bit too large as compared to his entire portfolio. So the goal with this portfolio is simply just to compound for him. So he's currently around 19 years of age. I would like to get him started early in this investment journey. So the true compounding effect actually comes into play as your time horizon increases. So for example, Warren Buffett, he made most of his wealth in the last 20 years of his life as compared to the first 70 years of his lifetime simply because of compounding. So for his portfolio, here are some projections that I've included. So he currently has around $17,000 in this portfolio. So assuming a monthly contribution of around $800 and assuming he continually puts in money for the next 22 years until he turns around 41 years of age, assuming a 10% return for his portfolio, he will have around $800,000 by the time he turns 40 years of age. So the mere $17,000 that he's having right now will eventually turn into a big sum of money, and that's why I'm getting him to continually put in money until he eventually takes over this portfolio. As for my portfolio today, I'll be covering some of the positions that I would like to add to, and for my portfolio, here are the 4 positions that I'm actually looking to add. So it will be FICO, Visa, Others, as well as Copart. I'll be talking about Copart as well as FICO today. So for Copart, the stock is down around 18% year to date, currently trading at a 28 times of earnings. So for Copart, here are the 2 main questions that were brought up during your earnings call. So the first question was with regards to assignments. So Copart's management team actually came out and said that assignments are declining, and assignment is actually a future growth indicator of your growth prospects. So for Copart today, what this means is that the assignments are dropping, and when your assignments are dropping, it eventually means that the sales for the company in terms of volume of cars will drop as well. So this is a worrying sign for the company, Besides that, the company is holding a lot of cash. They're not doing anything with the cash yet, which clearly means that the stock price today is not attractive enough for them to want to buy back shares, which I don't disagree with. So for Copart today, I think it is a decent company if you're looking to start a position. I think the company is around fairly priced today, but the company will probably see some headwinds ahead. And when that headwind comes and the stock price gets hit, that is when I will probably add to my position again. As for the next stock that I'll be covering is actually FICO. So FICO is down around 25% year to date, currently trading at a 57 times of earnings. So for FICO, here are some napkin numbers. So if you're to project the free cash flow over the next 5 years to be at around 20%, so assuming that pricing power remains, and assuming a 15% growth there on out till year 10, assuming a 4% terminal growth rate, this company is currently trading at around fair value. So for FICO, I actually did some calculations as well. So this was my model that I actually built out. So assuming the FICO score actually increase in price over the next few years from $4.95 to $9.40 over the next 5 years, and assuming the number of scores sold actually normalize to around 8 to 10% as your mortgage market recovers over time, FICO's fair value today is at around $1,500 a share. So for FICO, I view it as a decent company and I will look to continually add to this position if the market keeps giving me opportunities. But of course, I'm holding out right now. I'm waiting for a deeper drop for me to want to add to my position. And besides that, I will probably be writing up on FICO in this Substack here. So if you're interested in some of the write-ups that we're coming up with, please feel free to check this one out. It's in the description box below. Last portion, I'll be covering some questions left in the comments. So the first one, it says, "Hey bro, nice video. However, why buy or consider any of these stocks in this video? Some of these stocks are oversold, yes, but just look at their single-digit growth numbers, lower guidance, and negative sentiments around them. You're better off putting your money into S&P 500 at that point. You're young, so you can take more risks and should be taking advantage of this AI boom. Get into more tech, drop the losers in your portfolio, and buy the winners. Buy the Max 7, buy your fintech, buy your healthcare, quantum computing, energy, and other good winners like Brookfield Management, AMD, Grab, Shopify, Nubius, Nubank, I'm not sure what that company is, GLW, dLocal, as well as Baba." So this is what I actually responded to him with. So I said, "Hey, thanks for the input. My personal preference is to make money in a predictable way, be it value investing, quality investing, or growth at a reasonable price. So I prefer holding high quality stocks that can weather any storm, that won't collapse after a mere or short-lived credit crunch." So for example, in your 2008, for example, in your COVID crisis, a lot of the companies actually went out of business because your credit event actually caused a credit crunch, which means that the liquidity in the markets actually fell, which means that companies couldn't borrow money to sustain their operations. So that is one portion that I'm worried about when it comes to buying all these speculative names. Besides that, I actually also stated here that a lot of the companies discussed, be it your quantum, being your data companies, have no fundamental backing and are moving on pure speculation. I'm confident that a number of those names won't be around in 10 years' time. That is a problem that I have, and most, if not all, my holdings probably will. Time and age is on my side, yes, but it is easy to say this in a bull market, a rapid and historical bull market. Most market participants today forgot what happened in 2022 when we had a sustained drawdown for one entire year where your stocks fell like 80-90%. So for example, ARK investment is actually still flat since around 5 years ago because they actually bought a lot of speculative names during the 2022 bubble. And even Tom Lee flipped bearish in April. So I prefer capital preservation, and while I'm not bearish on the stock market today, I'm certainly not bullish as well. So market valuations are high, and that's why you're seeing all this quantum computing. You're seeing companies like Oklo going up without fundamental backing, or on pure speculation, of course. So that's why I'm avoiding all these different companies. I don't want my capital to be tied to all these names, because when the bear market eventually comes, all these names will fall 80-90%, like what we saw in 2022. Next one, it says, "I like your investment style and choice of stocks. I prefer concentrated portfolios myself. What is your long-term agenda? Retire early or become the next Warren Buffett?" So this is my logo in this entire YouTube channel here. This is my goal, of course, which is to achieve financial freedom. I'm sure most people on this channel probably want the same as well. It is to retire early, which is your FIRE community, financial independence, retire early. So I'm currently still young. I'm trying to build up my war chest. And if you're interested in joining this journey as well, feel free to subscribe to this channel or like the video. That's all I'm asking for. and stay tuned for more videos like this. Hopefully you guys have found this one useful and invest safe.